If you're considering about buying Fubo TV shares in your portfolio, then please keep watching this video until the end because it covers many of the factors that should be considered regarding buying, holding, or selling the shares. During the most recent trading session, the stock opened at $23.90 and closed at $23.74. The lowest point at which it fell to was $23.74 and the highest point it rose to was $26.49. Compared to the current price action, its 52-week low was $8.12 and the 52-week high was $62.29. The current trading volume of Fubo is around 16.4 million shares compared to the average of 16 million shares. Essentially, Fubo has maintained a fairly constant trading volume compared to the average trading volume. Given the current price patterns of Fubo, this means that the price may finally be stabilized since its recent low, but of course, it may still be too early to talk about any price trend reversal. The short-term trend of Fubo is that the stock may be ending the price correction since early 2020. This trend reversal may still be too early to call, but given the recent increase has been significant enough to be considered as a signal. The long-term price trend of Fubo is that the stock has always been in a massive bullish run, and the recent sell-off is simply a temporary price correction. The support has been around the $17 to $20 range, and this bullish trend may continue to go higher. From the price actions pattern, it would be up to you to determine if the stock still has enough steam to go upward, regardless of the company's latest fundamentals. I personally think that it does. Now, let's take a look at the market capitalization of the company, which represents how much the company is worth in the eyes of investors. The market cap of Fubo has been a very bullish run since its creation, but it really increased at a historically high speed in 2020. With that being said, even before the time that the market started to take off, it increased at a rate between 100% and 500% compared to the previous year, and in 2020, the market cap increased by more than 10 times. Despite the massive price correction since early 2021, the market cap of Fubo is still very high at $3.3 billion, the highest to date. This means that the market believes that a company is worth a couple $1 billion, and despite all the negative market sentiment, another outside signal to observe is the total number of shares outstanding. Generally speaking, if the number of shares keep increasing, then it suggests that a company is selling the equity to keep the ship afloat. The number of shares also increased significantly over the years, from 2.7 million shares in 2017 to 140.5 million shares in the present day. In this regard, Fubo is actually diluting the existing shareholders more than many other tech and growth stocks, because they've been selling more shares to balance the books. We have to be careful about this tendency because this would be an actual red flag for investors. The summary of what is going on with Fubo is that despite the existence of a lot of issues ahead, such as ongoing class lawsuit, the increasing competition of sports betting, and the wall of reality check that hit the company earlier than predicted, the bad news have been priced in, and they didn't stop the company from recovering a significant chunk of the losses so far. Going forward, I think that the stock does deserve a second chance. Meanwhile, the financial market's overall sentiment is still relatively reluctant at putting more money in the same genre of corporations. Following the stock market craze back in 2020, the stock market decided to pull back massively from the entire disruptive, innovative, and growth stock scene, covering biotech, electric vehicles, and anything requiring a keynote presentation to attract the VC capital. This wave of pullback can be explained in two ways. The market needed niches to park their capital in to avoid getting heavy losses, and the stock price of those companies increased multifold, Many of them then decided to lock in the profits by liquidating their positions, which triggered the sell-off. The second reason was because the market began to realize how overly exposed investors have become to the growth stock. These are the main reasons why the stock market ultimately collapsed for so many companies that everyone was talking about. In the current circumstances, the recommended approach is to be careful when buying those shares. On one hand, the stock may be able to climb back on its own when operations start to take off. On the other, the stock may simply increase because it fell too low. This means that the current market settings, we need to tread the water carefully regarding when to buy shares and how many shares we want to buy. Many of them have become overpriced over the past 12 months, and we may need to wait for another few weeks or month before the timing is ripe to increase our holdings. With that being said, there will always be sudden events creating volatility for individual companies, and this is why it is always recommended to hold a relatively small position in those stocks just in case you fear about missing out. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.